Good morning. I'm with Simon Marcotte. Simon was the former CEO of one of my best wins of the last couple of years. And we're going to get an update from him. But really, the point of this conversation is to talk about gold and why Simon is so bullish on the gold market for the rest of the 2020s and obviously for the gold mining sector as well. So, Simon, thank you for joining us.
Anytime. Always a pleasure to be on, Robert.
Yeah, so tell us a little bit about what you've been up to the last couple of months. I guess the transaction closed about, 6-7 weeks ago. Yeah, so, what are you up to?
So we closed the transaction just late in December. So that was good timing to enjoy Christmas. And I've been spending most of my time watching the price of gold go higher. Because obviously I still have 100% of my shares and I have no intention of selling any of that anytime soon. But obviously we also want to start other things in gold because we have the team of Northern Superior. And also we had about 35 institutional shareholders in Northern Superior that are quite keen to support, wherever else we're gonna deploy that team. So don't want to wait too long before we start something new. I would also mention that I spent most of my time since the closing of the Northern Superior transaction to focus on Black Swan Graphene, which is a company that has a lot of good things happening and new strategies being implemented. So maybe I can come back soon on your channel, Robert, to talk about Black Swan Graphene. But I know that you wanted to talk about the gold price and the gold sector today. So let's revert back to that.
Yeah, absolutely. So, okay, so that's Swan is the symbol on the TSX Ventures. So we'll table that for a conversation at a later date. But yeah, I'm definitely interested in what you have to say about gold here in 2026 and what you see coming over the next few years. So that's interesting what you said about IMG, because the share price continues to perform exceptionally well. And I know that, at least I'll speak for myself, the temptation is always to take profits, especially after a move like we've seen over the last couple of years. I don't know. How high can this go, do you think?
It can go a lot higher. And I'm happy to share my thoughts about Gold maybe later in the conversation. Because I think that Cote Gold, the Cote Gold Mine in Ontario, is the most strategic gold asset in the world for a few reasons. So I will review that. But I've also been working kind of to update my thesis about gold going a lot higher. You remember that a while back, gold really had yet to move. Gold was just starting to move. Gold stock had seen nothing at all at the time. It was literally the week following Liberation Day, as President Trump calls it, that I came out going, this is big. It's a change. Those are tectonic plates switching. So I came out with a thesis, if you remember, discussing gold 30,000. Where I said that gold would go from roughly, I think it was around 3,300 at the time, to 30,000 in just about the same time frame that oil had seen a move from $12 a barrel to $140 a barrel. And I'll tell you, it's happening a lot faster than even I expected. I couldn't talk about everything into that original thesis, but I focused on two things. First, the paper from Stephen Myron. Since then, Stephen Myron obviously now has become a very well-known figure. He's now joined the Fed. And the other thing that I was discussing was Chapter 24 of Project 2025, which so far hasn't brought much attention. But I think it's time for us to pay more and more attention to that paper, and I'll review why. If you want, I can even share the corporate deck that I've started to work on.
Yeah, go ahead and share your slides.
I mean, I'll warn you, it remains a bit rough around the edges, but so it's a bit of work to do. It's kind of a first draft, but the ideas are there. So if you allow me, maybe I'll. Does that?
Yep.
All right. Is this work? You see this?
Gold 30,000. Yep.
Yeah, happening faster than expected. Where are we now? Right. So there's about 20 slides here, Robert. So I'll try maybe to plow through this, and maybe after that we can have open conversation. So the first thing, I always like to say we saw some volatility recently, right? I always joke around saying that a bull market is called a bull market for a reason, because it will have its ways to shake you off its back. So don't be afraid with the volatility. It's going to remain for a while, and it's normal when you see this type of bull market. I will review the nomination of Kevin Warsh, which did cause a significant pullback in the gold price. I will discuss the 2026 debt refinancing wall that we are seeing, and why it could lead to gold accelerating from this year. I also want to touch on what to expect in the rest of the decade. This is a bit less scientific, but these themes seems to happen decade by decade. And if this is the decade of gold, then gold could be a bigger market than the AI cycle that we have seen in recent years. And finally, as always, I'd like to review my favorite gold name and largest position, which is I Am Gold. So we now have a debt problem, right? So let's take a bit of a step back, because for years I've been saying that we didn't have a debt problem. There was a lot of wealth into the households to offset that, but now we do have a debt problem. And if we take a little bit of a step back here, so not only the US, but all advanced economies now have a debt problem. So the grand scheme of thing here, capitalism, which was to reinvest capital, morphed into an economy that was driven by credit expansion, which followed the end of the gold standard and the start of the fiat currency in the 70s. So credit expansion needed globalization to keep inflation down. And then credit expansion led to a clear wealth inequality, which led to obvious political changes that we've seen, especially in the US, but not only in the US, in many other countries. And now, because of those political changes, globalization is in reverse. So inflation is back, so higher rates are back. And because of higher rates, now the debt is a problem and everywhere, and countries are going broke, and a new system is needed, and a new system is on its way. And if you want to dive into all of these concepts, I suggest that you look into the work that has been done by Richard Duncan, which is an economist that I know well. So the other thing I want to point out that I think is very apropos these days is what Ray Dalio has been discussing. Ray Dalio, you know him well, is the founder of Bridgewater, has been discussing his new book, which is called How Countries Go Broke and the End of the Big Cycle. And a key point of the book is to conceptualize two main phases. Phase number one, that started in the US on the back of the crisis of 2008, is when the government, through the Federal Reserve, needs to print money to lower yields to support the economy. And as the Fed is buying bonds, we always kind of jump up and down when we gold investors when we see QE, but then we kind of regret it. And we've learned since then that when the Fed's buying bonds, then everybody wants to buy financial assets, and it really does little for hard assets. Ultimately, it will flow into hard assets, but it's really good for financial assets. So this phase in the US lasted until 2020, and it works until it no longer have much of an impact, just for the reason of diminishing returns, obviously. So the next phase, which in the US again started in 2020 with COVID, the next phase is when both large deficits and money printing are required. So at that point, the Fed prints money, which ends up directly into the hands of people that actually need it via larger deficits. And if the money goes to Main Street, it's very good for hard asset and less good for financial assets. And a good example of that was simply the COVID checks. That was a great example. And when people were receiving checks directly in the mail, you'll remember that gold and gold stocks were doing very, very well at that time. Well, Ray Dalio is even suggesting that the Fed should work with the Treasury Department to coordinate this phase. And as you've seen in the last 48 hours, Kevin Warsh is already discussing doing this. And frankly, I don't necessarily disagree. I mean, everybody will scream at the Fed independence, but if this is where we are at, well, then this is what is required. And Kevin Warsh is now discussing coordinating the Treasury with the Fed, which means that the Fed could provide or could buy as many bonds as the Treasury would wish them to do, which is really a form of yield curve control, which, as you know, is huge for gold. And Kevin Warsh is also discussing the Fed to stop buying bonds and buy more short-term Treasury, which is, further steepening the yield curve, which has been very good for gold so far. So this second phase, where the country prints money to give it directly to people, according to Ray Dalio, the second phase will accelerate when the current short-term business cycle will slow down. In other words, when the short-term cycle ends, it will break the long-term cycle. And Ray Dalio believes that we are kind of 2/3 in this short-term cycle. But I mean, since he published that book, now we are seeing already a big rotation within the equity market from the Mag 7 to more defensive sectors. That really doesn't take long usually for the economy to slow down after the equity market kind of makes that call. And I also bring your attention to what Christopher Waller wrote, and that's a quote that you can find on the website of the Federal Reserve. As you know, he dissented. He wanted to see a cut, and he wrote, just following the last FOMC, and I quote here: "The 2025 data will be revised downward soon to likely show that there was virtually no growth in payroll employment in 2025. Zero, zip, nada." Let that sink in for a moment. Zero job growth versus an average of almost 2 million for the 10 years prior to 2025. This does not remotely look like a healthy labor market, end quote. So obviously that doesn't seem to be the belief of the rest of the members of the FOMC, but I was quite shocked to see one of the members write that. So Kevin Warsh, his nomination triggered a gold sell-off. I'll say this: I think that to expect Kevin Warsh to shrink the Fed's balance sheet is like hoping that Elon Musk and Doge would cut the deficit by $2 trillion. I don't think anyone believes it. Yet gold sold off. But I was a bit puzzled by that, because gold has never been correlated with the Fed's balance sheet, and gold stocks have even less been correlated to the Fed's balance sheet. What has been correlated to the Fed's balance sheet has been the S&P 500 since 2008. And, the equity market didn't flinch on this announcement. So I don't think that anybody believes it. Whatever the reason, I don't think gold pulled back because of Kevin Warsh. I think it was psychological at best. I think the market, was moving too fast, and people were probably looking for a reason to take profit. And the fact that gold is already stabilizing, it's already back above 5,000, I think is extremely bullish. I mean, gold could have pulled back all the way down to 3,800, and it would have remained above its 200 days moving average. So who is Kevin Warsh? I think you'll find this interesting. So first, he was the counterweight to Ben Bernanke during the global financial crisis. He argued that QE would cause inflation. Clearly, we know that this was incorrect at the time, especially the way the QE was being done was good for financial assets. And in a recent interview, which I'm sure you've seen on Fox News, it now appears clear that Kevin Warsh is a Trump loyalist. At least his narrative is clearly that. So I mean, he was worried about inflation when Democrats were in charge. I'm starting to think of it a little bit like this. You know, when Republicans are in power, their narrative is all about the deficit, but when they are in power, then they explode the deficit. So you know, we have to be conscious here that the Fed may act the same way now. Now, more interestingly, and why I said you would like this, you know, Kevin Warsh is the stepson of billionaire Ron Lauder. Mr. Lauder made important financial contributions to Trump's campaigns. As a matter of fact, it is him who first gave the idea to Trump to buy Greenland during his first term. Then he acquired properties in Greenland before Trump came back with the idea in his second term recently. Not that any of this matters, but I think it shows how connected and part of the inner circles these people are. And now Ron Lauder was also seen, and you can find these interviews. He was making speeches at the Heritage Foundation, and it is the Heritage Foundation that published the Project 2025 document. So I kind of find that interesting. And if you compare what Kevin Warsh is talking about versus what was written in Project 2025, then I'm starting to think that Project 25 now has its influence well anchored in the Fed. So textually, in the recent Fox News interview, Kevin Warsh said the Fed policies need to be focused on Main Street. What the Fed does now is good for Wall Street. The Fed needs to take its balance sheet down and redeploy that money to Main Street so that Main Street can have the strong economy that we are seeing in the financial market. That is textually what Kevin Warsh said. Well, there's clear parallels here with what was written in Chapter 24 of Project 2025, where it says the Fed should stop paying interest on excess bank reserves, and there's a lot of them, 3 trillion, which amounts to a transfer to Wall Street at the expense of Main Street. The Fed should stop paying interest so that banks can instead lend the money. Now, I'll just put a quick note here. This, you know, if the banks, you would think if the bank take those excess bank reserves and lend it to the real economy, you would think that it would shrink the Fed's balance sheet, but that's not what's really happening. If one bank lends out that money, well, whoever borrows that money will put it into his bank, right? So it doesn't really decrease the bank reserves or the Fed's balance sheet, but it increases the velocity of that money, which either lower yields or increase inflation, depending on the view of the population towards the economy, obviously. So either way, it lowers real rates, which is huge for gold. And that was one of the points I was making in my first publication. Now, Project 2025 even suggests returning to a hybrid system where a gold standard would be allowed to operate alongside the current fiat dollar. What does that mean? I am not sure. But when I said that a new system was needed and on the way, I think some people are very serious about it. In a different interview, which you may have seen as well, an interview that he did at the Reagan Foundation, Kevin Warsh said that we were at the start of a new 45-year cycle. I picked up this chart online, and I thought it was interesting. We see a clear 45-year cycle between 1980 and 2025, and now in 2026, it's breaking down. This is the Dow to gold ratio, which, as you know, Mr. Lasson believes should return back to 1. If that would be the case, gold could go even higher than even I'm talking about. Now, the other point that I wanted to discuss is this wall of debt that the U.S. needs to refinance. I'm sure you've heard this. About a third of the U.S. debt needs to be refinanced in 2026 alone. I think there's like 125 billion this week or something, or next week. But more importantly is how the debt is currently being refinanced, because it steepens the curve, and it is clearly good for gold. So a little bit of let's step back here a little again in order to understand the dynamics. So hedge funds are now buying a lot of the new debt being issued, as crazy as this may be. So let's step back. So in recent decades, especially since 2000, when American would buy a product from most Asian countries, but I'll just use China to make it simple. American would buy a product from China. Normally, this would put upward pressure on the Chinese currency. But then what China was doing was China was printing its currency and buying that US dollar that was coming in order to keep its currency stable. Then China had this new dollar, this new US dollar. So if it wanted to earn a yield on it, it would buy a US Treasury. So simply put, the more the United States would import from China, the more easily it could finance larger deficits. But now things are a bit in reverse, right? I mean, China now is selling more to the rest of the world, less to the US. America is buying less from China. So China is buying less Treasury, which opens the door to hedge funds to buy Treasury via what they call the basis trade. So what is the basis trade? First of all, it seems to be much larger than what people believe. There was a recent staff paper, as they call it, that was published in 2025 that estimates that that hedge funds located in the Cayman now hold close to 2 trillion of Treasury, which would be more than any foreign country. Now, what they do is they buy cash Treasury, so they use their own capital, obviously, but then they leverage it 50 to 60 times using the very liquid repo market to buy the Treasury, and then they short the Treasury's future on the same terms. So that would explain why you're seeing this huge ramp up in a short position in the Treasury right now, with as you can see on the chart on the right. So the basis trade is not new. It was actually invented in the 80s. It started in the 90s, but it really exploded in recent years. So what's the consequence of the basis trade? It is a steepening of the curve, right? And a steepening of the curve, I mean, it could be good for gold or bad for gold. I mean, it's bad for gold if the curve is steepening because the economy is doing well, there's more earnings, and the economy or the world has confidence that the Fed will fight inflation when the time comes. So rates on the long end is moving up. That would mean the market, has a high confidence in the central bank. That would be bad for gold. But if the curve is steepening because the short end is coming down because of financial repression, which is really what's happening now, then a steepening curve is very, very good for gold. You don't need to ask yourself the question. The curve is steepening, and gold is doing well. So clearly, the current situation is good for gold. And because of this wall of debt that needs to be refinanced in 2026, and the way it is being refinanced, then I think that gold could actually accelerate from here. And also what Mr. Kevin Warsh is discussing now to do this deal with the Treasury to coordinate, and also discussing the fact that the Fed should stop buying bonds and buy more Treasury. That's further steepening of the curve, would be very, very good for gold. So, the other thing to keep in mind is another impact of this basis trade is because everything is being funded through the repo market. This situation amplifies instability. So if the repo market is experiencing volatility, then hedge funds need to unwind trades. And we saw an example of this in 2020 at the beginning of COVID. So, I also don't expect another repo crisis, right? The Fed is probably watching the repo market every 5 minutes and will fund it as needed. So the impact is that, there's a need of a constant Fed put. And that's why we see, the VIX and the volatility and all this at years low. That's the reason why. I don't want to dive too much into the geopolitical impact, but we also have observed in recent years that the repo market is seeing an increased volatility following geopolitical events. So which means that gold could start reacting more and more to geopolitical events, like in the 70s. Now, I have no interest in discussing U.S. politics, this may sound a bit controversial, but I think that investors should start warming up to the idea that in 2029, by the end of this decade, the chairman of the RNC and not the president of the United States could reside in the White House. So, needless to say, we live in very interesting times, and not only in the US, we see political changes globally. And another thing that just came out this morning, Robert, remember when China suggested its population should start buying gold a few years ago? That was the right.
Yeah, that was the right move.
Well, now China is urging its banks to curb U.S. Treasury exposure. So if it's a call that's just as good, that would be very bearish for the U.S. dollar and very good for gold. I always say this as well. This time is different. We always hear, people start laughing when things are getting too frothy, and people go, oh, so this time is different. It's not going to reverse back to the mean. I think this time is different. Just psychologically, we typically see a stock market crash, more or less every 10 years. So we have experience in our lifetime, and that's why people always expect a reversal to the mean. But what we are seeing now is a currency crash. What we see really every 100 years, every 200 years. So we never have an experience in our lifetime. So yes, what we are seeing is a currency crash. So yes, this time is different. So not only everything will keep moving up, as it is the currencies that are going down, but also the Fed can't let the bubble of everything burst, because we've been living in a world of bubble after bubble after bubble, and every previous bubble, when it was bursting, was offset by the start of the next bubble. Well, now we've been in the bubble of everything for a while now. So let's be clear: if the bubble of everything burst, there's nothing left. So the Fed can't let the bubble of everything just burst. I mean, there's no way that just the gold sector is going to lift the entire economy, right? So, I don't think that people should be too worried about asset prices coming down. So the other thing, and there's absolutely nothing scientific about this, but for some reason, investment themes seem to coincide with the beginning and the end of specific decades, right? So remember if you go through this chart here, European stocks in the 50s, the Nifty 50 in the 60s, obviously gold and commodities in the 70s, Japanese stocks in the 80s, the tech bubble in the 90s, again, China driving a commodity boom in the 2000s, and the mega caps in 2010, and now we're in 2020. I will warn though that semiconductors, the semis have really broken this tradition, and the semis have performed for much longer than a decade now. But like I mentioned earlier, the equity market is now experiencing a cyclical rotation into defensive stocks. So if we were to return to the traditional intra-decade theme, and gold does accelerate in 2026, then by definition, gold could end up being the theme of 2020, the 2020s, making it a more powerful cycle than what we've seen in AI in recent years. And I certainly think that's actually in the cards. So you've seen those chart. How much upsides on the left here? It is the hard assets versus the financial assets. As you can see, that's Bank of America. We are absolutely rock bottom. And again, it is the hard asset that needs to catch up to the financial assets. You don't let the whole system crumble. So we have a lot of upside on the right, from Tavi Costa, where he points out to a potential third downward cycle for the US dollar. And here for gold stocks, I mean, because gold is running faster than stocks, gold stocks have never been this cheap. And if gold, stays higher for longer, then the market starts believing into it. It's exactly what happened to the oil stocks in the 90s. At first, the market was not paying for the oil price because the market thought that oil was going to go back to $12. Well, at some point, the market woke up. So 2024, we saw gold breaking out. 2025, obviously, silver broke out. I think 2026, 7, the rest of the decade will be the equity catching up to the gold price. So I don't think really that the game has started yet. So that's kind of my review of where I stand on the macro front. And if that's okay with you, I'd like to kind of review my thoughts on IM Gold now, unless you want to discuss anything on the macro front, Robert.
Yeah, no, let's talk about IM Gold. It's up 9% today as we speak. It's absolutely ripping higher. Go through the IM Gold, and then I'll ask you a couple questions about the macro after.
Sure. Obviously, I am long. As you know, we sold Northern Superior to IM Gold. A lot of people were asking me, why did you decide to sell Northern Superior if you're that bullish on gold? And my answer is because I am even more bullish on IM Gold itself. And to be clear, I'm not saying here that you should expect IM Gold to be acquired right away. I think ultimately, yes, but don't expect IM Gold to be acquired right away. I'll say it's better than this. So the way I like to look at things is gold stock, as we are entering a revaluation phase of gold stocks valuation is really moving from a discount to an NAV or value versus the NAV toward the cash flow multiple. And I think this is just starting. I think gold stocks will be valued as growth stock in the coming years. So most of the value of IM Gold is obviously the Cote Gold Mine in Ontario. IM Gold is not getting the full value for Essakane, clearly, because it is in Africa. But what I thought was absolutely brilliant here is that IM Gold announced a share buyback, and they have been active. So it looks to me like IM Gold is using the cash flow from Essakane to buy back shares. So if gold goes up, then IM Gold has more cash to buy back more shares, which should lead to IM Gold outperforming its peers on a cash flow multiple basis. So I think that's the strategy behind what's happening there. So I would say that if it doesn't work, if IM Gold does not outperform its peers with this buyback, then I wouldn't be surprised if IM Gold eventually divests Essakane. And if that would be to happen, then the market would immediately pay a takeover premium on IM Gold, because now it would be really only a Canadian story, which probably fits better for the company to be acquired, right? So I want to come back now to the main Canadian asset of IM Gold, which is Cote Gold. I think Cote Gold is the most strategic gold mine in the world. Why? Well, take it from the top down, right? Canada is the only country whose currency has been underperforming the US dollar. So if anywhere on earth you want to be producing gold right now, it's Canada. So let's look at Canada. Agnico Eagle controls Canada, right? Agnico Eagle has 6 of the 7 largest mines in Canada. Obviously, the one they don't own is Cote Gold, but because they have a complete control on the Canadian gold industry, Agnico Eagle has the best equity paper that I can see, probably along with Goldfields, that also has a good paper, very well valued. So Agnico needs to own IAMGOLD to keep its control on Canada, right? And also, if I'm right, and the game is really changing from a discount to an NAV to a cash flow multiple, then Agnico needs to have very long mine lives. And they have very long mine lives at Detour and at Malartic, but a lot less at the others in Ontario there. So buying IAMGOLD would fix that. And by the way, the mine life of the other operations can definitely grow through the drill bit, no doubt. These are systems that can grow. But the market, in order to pay for a higher cash flow multiple, if the market really re-rates the sector like this, then you need to have those proven. So buying IAMGOLD, buying Cote Gold would really give IAMGOLD a much longer mine life, globally speaking, in Canada. And I would say that if Agnico doesn't buy IAMGOLD, then eventually someone else will want to be involved in Canada. I can think of Kinross, can think of Anglo, can even think of Barrick that recently confirmed that they want to do a North American spinco. That would be a good fit for that too. So if someone else does acquire IAMGOLD, then it would probably put increased pressure on labor cost in Canada. And also the next time a mine like this will be up for grab, then Agnico would face competition. So I think that Agnico eventually will buy IAMGOLD, not in the short term. And I think that if Agnico doesn't buy IAMGOLD, then its premium paper is probably at risk. And I think that's all I had to say about IAMGOLD.
Okay, it makes sense. So divesting the African assets would make the share price trade at an even larger multiple to NAV, and it would set the stage for a senior gold producer to acquire the company. That makes a lot of sense, because I know that Agnico is not interested in the African assets. That's not their style, right? So I think that makes a lot of sense. Like if we see them divest the Essakane mine, then that would be very bullish. I think even the announcement that they're looking to divest it, I think would be very bullish for the share price.
That's right, but I think that IAMGOLD is being prudent, because if they announce a divestment of Essakane and then the stock goes up and then nothing happens, then they're going to lose their takeover premium. So I really, really like the strategy of doing a buyback for the time being. I think that's brilliant, and they've been active to it, right? And right now, as you saw on the chart, the equity market is not paying for the current gold price. Well, IAMGOLD will, the market will need to pay for IAMGOLD in the equity, because if not, IAMGOLD is taking the money they're getting from the cash flow of Essakane and buying back shares. So it's forcing the market to pay up for the commodity price. So it's very interesting to have that in place.
Yeah, no, that makes a lot of sense. That's a very clever move, and yeah, I mean, you can't argue with the uptrend, you can't argue with the chart, and you make a compelling case that this is still undervalued, because, as you said, the market is actually not pricing a lot of these gold miners for $5,000 gold. I think they're still probably priced more in the $3,500 to $4,000 range. So just even if gold treads water here for the next 6 months, the gold mining sector should do very well. I want to go back to the gold presentation. You mentioned the slide on the debt, refinancing that the Treasury Department has to do in 2026. I'm interested, do you think that's a catalyst by itself for the gold price, for gold and silver, that just simply the fact that Treasury has to place all this paper, and most likely that will lead to some sort of yield curve control kind of activity between the Fed and Treasury, that in itself is a very positive catalyst for gold and silver.
That in itself, right? That's an important context, because there's so many other things that can impact the gold price, right? But we can't review everything at once. But normally you would think if there's so much debt to be refinanced, it's going to increase the yields. And then if you can get a lot of yield somewhere, why buy an asset that doesn't provide any yield? So instinctively, you think it's bearish for gold, but it's not, because the way the debt is being refinanced really pushes the curve to steepens even more, which clearly is being read as financial repression, which clearly has been evidently what we've seen over the past 48 months. It's very good for gold. So I think thing could accelerate. If everything else remains the same, I think gold could accelerate here in 2026.
Yeah, very good. Okay. And then that Dow gold ratio, that is definitely something to ponder. The Dow is at 50,000. So if it goes 1-to-1, there's a lot of upside left.
That's right. And President Trump is now calling for a Dow to go to 100,000 by the end of his term. So I'm almost hoping he's wrong, because that would mean that the currency is debasing even faster than what people believe. But if that would be to happen, I mean, imagine the upside that you have in gold, because hard assets need to catch up to financial assets. Practically speaking, same thing, right? I mean, young people can't buy a house. The average age for someone to buy a house used to be 30 years old. And since COVID, it's 40 years old. That's a big, big difference. At 30, you still feel young. At 30, at 40, you're kind of, you're getting close to the top of the hill. So that is not right. Young people are pissed off, and they have absolutely the right to be pissed off. And that's the reason we're saying so much changes politically and geopolitically, because the system doesn't work for them. Well, you can't crash the price of houses. That's not going to help anything, because if you crash the price of everyone's houses, then every mortgage is way underwater, and that problem just got 100 times more of a problem. So what you need to do is keep the house at the same price and increase the salaries of people, right? Which is an inflationary cycle, and that happens through financial repression, which clearly we seem to be entering. If that is actually the case, we have seen absolutely nothing yet for the gold price. We have seen absolutely nothing yet for the gold equity performance.
Yeah, I think that's a very important point that people need to take away, because if some of the things that you say are going to come true in the next few years, including the commentary about the 2028 election in the US, then we've just scratched the surface here on this move. I'm going to ask you one more question, Simon, and then we'll wrap it up. I think this was very good and very instructive. The silver move. I know some people are concerned by the silver price action the last couple of months. It got parabolic there a few weeks ago. It had a pullback. It's consolidating pretty well above $75 an ounce, but a lot of people say anytime silver's had this kind of parabolic move, like a blow off move, that's the end of the cycle. We're at the top. What do you say to them?
This time is different. This time is different. The gold, if you look into the last few decades, which is where all of our experience is based on, they were very short-term gold moves, right? And yes, every time silver started to perform and started to catch up to gold, it was the end of it, because it was the point where, you know, the retail was getting into the space. This time is different. I'm sorry, but it's a very, very different driver. The gold to silver ratio remains pretty out of whack. Expect silver to remain much more volatile than gold, that it's a smaller market, a more speculative market. But I don't think we've seen anything yet for the price of precious metals.
Very good. Simon, thank you so much for your time.
Anytime.